There you are. Okay, wonderful. Nice to see you, Lance.
Yeah, thanks for having me.
Absolutely. So I'm filling in for Tristan. I'm trying to look a little bit like him. I need a little bit of a gray beard. Um, but yeah, thanks for joining, Lance. I actually reached out to you and talked to you right when you started ResiClubAnalytics.com. Gosh, it's probably about a year and a half ago. Is that right?
Yeah,
October 23?
it's been a hot minute now, but yeah, it feels like yesterday though,
There
still.
you go. Wonderful. Well, I'm really excited to kind of learn what you're seeing in the market. And anyone who hasn't seen your website, you're the founder of ResiClubAnalytics.com. I personally spend a lot of time on YouTube and analyzing the market, and your website is like hands down the best website out there. So, not a paid promotion, but it's a really good. You do a really good job of it.
Yeah, I appreciate that. And so are we live now? Are we already
We are
live?
live. We started like 30
Awesome.
seconds before you joined on. I was going to share like what's going on in the market, but I'm glad you joined on. So, can everyone hear us okay? I'm sure you guys can, assuming you can. Let's just kind of talk about the market. So, there's a lot of volatility. We have 7% rates, a little bit less than that. We have tariffs, federal layoffs, et cetera. What are you seeing right now? What's happening in the market? Really curious to what you're seeing.
Yeah, so I think the big thing is, always to kind of set the tone of what we went through. And I think that kind of helps to guide us to where we could go. And so the US housing market, you go back to spring 2020 and that first 2 years of the pandemic boom. During that period, the Federal Reserve estimates that housing demand had surged so much that new home construction, housing starts specifically, would have needed to increase 300% to match the increase in housing demand during the pandemic housing boom. And so housing starts and home construction, they're not elastic like demand. Demand is way more elastic up and down than supply. And when I mean supply there, I mean the actual housing stock in the US. And a lot of that housing stock dates back to 70s, 60s, 50s, 40s, right? And so it can only go up just a little bit per year. And even going up 100% from 1.4 million housing starts to 2.8, that's not possible, right? Because there's supply chain constraints, there's labor constraints. Only so many people, know how to do the things to build a home in any given, and to increase and to double that in a year just doesn't, it's not possible, right? Let alone to go up to then, almost 5 million, 6 million housing starts. It's not possible. And so all of that housing demand, which was spurred by stimulus, ultra low rates, the work from home arbitrage effect, and the increased demand for space, what that did is it just layered so much demand on the housing market and it couldn't fulfill all that demand. And so when you can't have all the demand fulfilled, what happens in economics? Prices overheat. So those who pay the most are the ones who actually get to transact. So all of that, right, that demand overheats prices. 2021 is actually the biggest 1 year jump ever for home price growth, 21%. Even in the 70s, when inflation was roaring and home prices were soaring, we never saw a 21% national increase in 1 year. And so within, 18, 21 months, national home prices are up 40, 45%, and in some markets up 60, 70, 80%. And so that, of course, was followed by a historic rate shock. The inflationary shock that had occurred subsequently has the rate shock that occurs. And so mortgage rates go from 2, 3, 4, 5, 6, 7% very quickly. And so all of that, if you look at it, and then you also account for incomes just haven't kept up, right? And so we saw a historic deterioration in housing affordability. On a nominal basis, the incomes to buy a home, the typical US home, the income to do it is what you would need is up 79% in 5 years, right? And incomes are not up nationally 79% in 5 years. And so what that historic affordability shock has done to the market is that it doesn't just hit buyers, it also hits sellers who would like to sell and buy something else, right? And so there is a chunk of the churn in the housing market that's just not occurring. And yes, some of it is folks who, have 2, 3, 4% rates. 79% of all outstanding mortgages are four handle or under. But a lot of it is, and so some of them don't want to give up that rate, take on a higher monthly payment. But a lot of it is also that a huge swath of homeowners could not afford to sell their home and buy it today at today's prices and today's rates, right? And so they're not qualifying for the mortgage. And a lot of people, they would have to pay more even if they downsized, right? And so it's taken a big chunk of the churn out of the market. And so that's why, this US housing market today, for the past almost 3 years now, has been at around a seasonally adjusted annualized rate of 4 million existing home sales, down 1.3 million total existing home sales from where we were pre-pandemic. And during the pandemic housing boom, there at the height, let's say April 22, we had seen an excess sales of 1.3 million existing home sales more than if we had continued that 2019 trajectory, right? So if we had stayed at an annualized rate of 5.3 million and we'd stayed there, we would have seen 1.2 million fewer sales than we actually saw by April 2022 because there was more churn that occurred in the market during the period of ultra low rates, right? Well, since then, since rates shot up and a lot of that churn came out of the market, by August 2023, the housing market was back to even, right? So there was a pull ahead for existing home sales that occurred during the pandemic boom. By August 23, we were back to where we would have been if the pandemic had never occurred and we just stayed at a 2019 level of existing home sales, right? But since then, because we are so low for existing home sales relative to pre-pandemic levels, we're kind of going at 4 million seasonally adjusted annualized per year compared to 5.3 million before. Since August 2023, that gap of where we would have been if the pandemic had never occurred and pandemic and economics had never occurred, and where we are today, we've now seen 1.8 million fewer existing home sales this decade so far than if we had maintained the 2019 trajectory. And if nothing changes this year and we stay at where we kind of look that we're headed, like this still at this 4 million seasonally adjusted annualized rate, we'll go over 3 million lost existing home sales.
Yep.
Than if the pandemic had never occurred. And so now it raises the question of earlier we had a pull ahead, right? During the pandemic, there's ultra low rates. Some people who were going to wait and buy in 23 decided to go ahead and buy in 21, right? So there was some sales that occurred then that were kind of pulled from the future. Now it's a question, are we actually seeing a push out? Where some of the existing home sales that would have occurred in 24, 25, are they not occurring? And then are they getting pushed out to 26, 27, 28, right? That's what the industry would love is some type of catch up, right? This period of a lull, and then, we get to a period and we can get those sales back. But I just don't see that happening, really. I don't see this like big burst, right? Like we're going up to 5.5 million, right? Or 6 million. Instead, what I imagine will play out here is a slow grind up, right? For existing home sales. As people's lifestyle changes start to stack up, people who are in 2-bedroom homes, now they maybe have 2, 3 kids, and the wife's maybe starting to get unhappy. She wants more space. As that side of it changes, right? You'll have the psychological cost of the switching cost start to stack up, right? And so a switching cost is anytime you go from one good or service to another and what that cost of switching is. And right now in housing, the switching costs are astronomical, right? Because they're giving up those low rates, low monthly payments for a much higher one, right? So out of the gate, in theory, the switching cost is the highest for a rate shock right out of the gate, right? Because that payment number jumps up right then. But over time, as the psychological side of the cost can start to mount up, right? These different lifestyle changes that can help to make that math in their head where they're like, okay, yeah, going up $800 on that monthly payment sucks, but having an unhappy wife also sucks. And so as those things start to occur, you'll start to get some of that churn come back into the market. The other two levers that are very important there. So one is the time with the lifestyle changes. The other is incomes, right? So if affordability doesn't continue to deteriorate, and we've kind of been in a lull for affordability, right, where rates are no longer shooting higher, they've come off the height of, 8% mortgage rates in October 2023. They're still high, right? Affordability is still pressurized, but it's not soaring up, right? And so if you give it time, as incomes rise, right, that affordability can ease up. So if people's incomes come up, right, somebody goes from making 150,000 household income to 250, $300,000 household income. And I'm using that example because I know some of you are in the West Coast markets, but you can play the numbers any way you want it. If that happens, yes, while the nominal change in the payment might be $800 more a month, might be $1,500 more a month, as their incomes rise, as that proportion of their monthly budget shrinks, right, for that new monthly payment, they're more willing to do it, right? That's a second lever. And then the third lever, and this is the thing the industry's been hoping for and hasn't really gotten, if we could get any more ease up in mortgage rates, right? If any drop in mortgage rates could occur, if we could even get another 50 basis points down, right? Get back to even where we were in September, where heading into late last summer, there were a few unemployment reports that, started to show the unemployment rate moving up faster than expected. And so the market priced in a little bit of inflation risk, and the average 30-year fixed mortgage rate fell to 6.11, hitting its low last year on September 11th. If you could get anything like that, another 50 basis points down, that could help to bring some churn back into the market. But you can't have mortgage rates fall 50 basis points, 75 basis points, and then shoot back up, right? The existing home, the particular type of sale that is not in the market today is a churn sale. So they're going to sell and they're going to buy something else. And for that person to actually do it, they need to have the confidence, right? That by the time they sell their house, they're, not in a completely different rate environment and they kind of, are getting, can't afford it anymore, right? So we need to have some duration in the drop in mortgage rates if we were going to see some more unlocked from that particular lever. But all three of those levers, it really goes back to time. And it's just going to take time to get existing home sales moving up. But Jason, I know that wasn't necessarily the question, but I kind of wanted to just set the tone for where the market is. This pressurized affordability environment, very constrained existing home sales. Now, in terms of where the market is today, it really varies a lot across the country in terms of that supply, in terms of the supply demand equilibrium between buyers and sellers. And across the board, existing home sales are very low. But then if you actually go into those markets, the supply demand equilibrium and that power dynamic between buyers and sellers ranges so much across the country. And because we're in such an affordability environment, certain moves in rates up and down throughout the year, and then the seasonal effect creates almost whiplash in some of these local markets where the power dynamics can swing so much so quickly. And so when you zoom out, what you'll see is that a lot of the Northeast and Midwest right now is still fairly tight. Active inventory for sale, which is kind of my proxy for the supply demand equilibrium, is in a place where it's still down 50, 60, 70% in a lot of these Northeast markets relative to where it was in the same month in 2019. So those are still fairly tight. I still expect home prices to rise this spring a little bit in a lot of these Northeast markets, a lot of the Midwest markets, especially the smaller, second tier, third tier markets that have a little bit more relative affordability, right? And then also the deep exurbs of some of these markets like New York City, where, there's fewer people leaving New York, San Francisco, Seattle to go to Boise and Austin right now, right? Like we saw in 21, but there is still the work from home effect where, maybe they got to go into the office 1 to 2 days a week, right? They're no longer fully remote, but they still aren't 5 days a week. And so for those people, they're more willing to go deeper and further out in search of some relative affordability. The donut effect around these markets like New York into deeper into Connecticut, deeper into New Jersey, as they kind of seek some of that affordability. And they buy in some of these parts of in some of these markets where they would have never wanted to do a 5 day commute into the city from there. But, if they have to do it 1, 2 days a week, they can manage it. They can do it, right? And so they're seeking affordability, pushing further out. Now, as you go into a lot of the Sunbelt markets, and it's been talked about a lot, like Austin, right? Southwest Florida, Tampa, Jacksonville, some of these areas like that. What's occurred in those markets is that they've been hit by greater demand shocks. And so what that is that during the pandemic housing boom, a lot of those markets saw even greater home price growth, right? So that strained fundamentals even more. And they saw a tremendous amount of inbound migration, net domestic migration. And so Travis County, where that's where Austin, Texas is, it saw a huge amount of net domestic migration. And then the past 2 years, they've actually been negative for net domestic migration in Travis County. And so that is a demand shock. When you go from having a lot of really high income people move in from New York, California, and then all of a sudden that comes down, you have to rely more on local incomes to sustain where prices got. So it creates a greater demand shock. The other thing there is in a place like, let's say, Austin, they had a lot of home construction, right? A lot of single family building out deep in the exurbs, even a lot of multifamily in Austin. And so in this shifted environment, builders, they make their money on volume. So they're going to continue to sell, continue to build if they can, as long as they have the margin. And what they've done is they've come down on net effective prices, done affordability adjustments in some of these markets. And when you're a buyer and you're looking out in this environment where, even though prices maybe have come down in Austin, a lot of existing home sellers fight it, right? And if you're a buyer, you're like, well, these existing home sellers are not coming down that much, but this home builder, he's come down and he's offering this 3.99 mortgage rate buy down. And so what that does is it moves a buyer who would have bought in the existing resale market and it moves them to the new construction market. And so as that occurs, the homes in the resale existing market sit on the market longer, take longer to sell, and active inventory builds. And so those kind of factors of the frothier prices, the negative demand shock from the shift in migration levels, and then the fact that they have a lot of new construction, they're more supply elastic. That's why some of those markets in the Sun Belt have softened or weakened more, even come down for prices a bit. And then versus a lot of those Midwest and Northeast markets, a lot of them actually were the beneficiaries of net domestic migration slowing down in the Sun Belt, because guess where some of it was coming from? Up there, right? And so then they have more people who would have otherwise left stay put. And those markets don't have much home building, right? So there's not that supply elasticity that, then those builders have to create affordability adjustments to keep moving volume. So they don't have that. The existing home seller is really the only game in town. And so they have maintained power. But if you zoom out on a national level, what you will see is that active inventory nationally is rising. A lot of it is driven by the growth that's occurred in the Sun Belt, but it is also occurring in some other markets across the country. And I expect by the end of this year, we're going to be up double digits again this year, just like we were last year for national active inventory. And I think what that
Year over
means is
year.
year over year. Yeah.
Yeah.
So the percent growth might come down, but the actual number of the unit increase might stay fairly close to what it was in the jump in 2024. Now, there starts to become some unknowns, what happens in the economy the rest of the year, what happens in the rate environment. The rate environment and if unemployment were to jump up, right, you would see the average 30-year fixed mortgage rate come down a bit. 10-year treasury yields would also come down a bit. But depending on what type of shock could occur there with employment, the outcomes could really vary. And there could be even greater significant regional variation if that were to occur. So I don't want to get into too much of the hypotheticals with that because it's just a lot of unknowns. But as of today, the unemployment rate is still fairly low. and the 10-year treasury yield, why it's come down a bit over the past few months, is still at a place that's not necessarily indicating that financial markets think that a recession is imminent. The odds have come up just a bit because there's a little bit of the volatility with the tariff stuff. But again, even with the tariff stuff, it's really hard to know how that's going to play out. And you have to get into a lot of game theory in terms of like, what is this world leader going to react with this proposal? How then would the Trump administration react if they reacted this way? Is a lot of this just a negotiation ploy? And so you get into just so much game theory with it that it's kind of hard to know what the outcome with tariffs would be. But if I think some people take tariffs and they think of it as, a huge inflationary spike, right? I think of it a little bit of the opposite, where I think it would more likely be a drag on the economy versus so so it'll hit margins, right? Right, it would hit margins. The companies don't have as much pricing power, and even builders have much less pricing power today than they did. So margins would compress, and that would be a hit to activity in the economy, which could actually potentially bring rates down a bit. But it becomes some unknowns. And even if you listen to Jerome Powell, he's very conflicted, and the central bank is very conflicted in terms of how tariffs would react to inflate, or how inflation would react to tariffs, how unemployment would react to tariffs, and how the bond market would react to tariffs. It's still a lot of uncertainty there. So I think that's the biggest area of uncertainty this year. And I think that the industry is just hoping to see existing home sales start to come up a little bit. And I think the quickest way we could get there is if we could get just another 30, 40, 50 basis points decline in 30-year fixed mortgage rate and it actually sustain.
Yeah, I 100% agree with you. I mean, like the median number of home sales nationwide of the existing houses is around 5 million. And we've been around 4 million for 2 years in a row now, and then maybe another 4.1 million this year. So we'd be missing around 3 million transactions, like you mentioned, due to all those issues that you were talked about. So I really appreciate your insights regarding all of that. Anything else you want to add regarding the housing market right now?
Um, you know, uh, I don't think there's too much. I think I've covered a lot of the big picture that I wanted to get into. If you want to know where the epicenter of like weaknesses in the housing market right now, it's the condominium market in Florida. A lot of that is it's some of the factors that I mentioned earlier with the migration and then the supply elasticity, but it's also because the Surfside condo collapse that occurred in the second half of 2021 killed 98 people as that building collapsed. The state legislature in Florida passed measures that then tried to prevent so much deferred maintenance from these older condo buildings. And what that did is it put upward pressure on the special assessments and the HOAs of those buildings. And a lot of that came into effect at the end of last year. And so the condo market in Florida is seeing a shock there. And the markets that I track down to a zip code level, it's over 95, 96% of Florida markets are seeing falling condo prices year over year. And then single family, there is also weakness in the southwest part of Florida in particular. So everything pretty much south of Tampa, down to Naples, with the biggest weakness being Cape Coral and Punta Gorda.
Yeah, interesting. Yeah, the other issue with Florida and then Texas as well is the increases of home insurance and of course taxes as well. But like you mentioned, the condo situation, especially condos that are 30 years or older in Florida, I mean that is just a challenging market if you're trying to sell your condo there.
And you're spot on with the insurance shock. I didn't get into it, but yeah, you're seeing a bigger insurance shock there. And really nationally, you've seen a fairly big insurance shock, even outside of Florida and Texas. And a huge chunk of that is driven by what over at Resi Club we call the echo pandemic housing boom. So home prices overheat, 45, 50%, let's say. Some markets it's a little less, some markets more. And so construction cost also went up right along with it, right? We saw huge overheating on construction cost for inputs, labor, all of that. And so, given that uh, replacement costs are so much higher in today's housing market, if a home is destroyed, that puts upward pressure on insurance. And so, we initially saw the overheating in construction prices and cost and home prices, and then that is echoed over into insurance. So that's one part. And then you do have, higher disaster risk getting factored in to some of these areas. And then there's also the factor that we have increased the amount of construction in the country in this very specific areas that have the highest disaster payout risk, right? So that's another factor that's getting played out. And we hopefully will start to see some of this increases decelerate. We have seen it decelerate a bit in the commercial market, which is a little bit ahead of the residential market. But a lot of this is a echo pandemic housing boom. And there's also an echo pandemic housing boom occurring for property taxes, right? And every state and even down to some municipality county levels, the property taxes are done very differently. Whereas like Texas is very fast to feed in property taxes, right? From increases in home prices. And Texas is not only so fast that it's already increased a lot of the upswing in prices, but even in places like Austin, they've also factored in already the downswing, right? They're so far ahead. Whereas like where I live in Ohio, we're very slow. It takes a really long time for that to feed over. Um, and so the property tax side of this is going to be a long-standing echo shock from this initial overheating from the pandemic housing boom. And it varies a lot by states. And, places like, California are going to be a little bit more buffered, right? Than
Right.
some of these other states are.
Yeah, definitely. And so in California, I'm in Sacramento as an agent, and our property tax basis, the property value of our that the tax assessor assesses our property can only increase by 2% each year, which is more or less in line with inflation over the long run. Much different than other areas like you mentioned, where property taxes can adjust based on current values. One thing about Austin is that there are so many people buying investment properties back in 2020, 21. You have a big surplus of people buying houses, but then now a big surplus of inventory. And because of that, rents are coming down on the ROI and an increase in property taxes and insurance as well, which is also kind of minimizing the returns that investors are having. That's one of the reasons why we're seeing an uptick in inventory there, but it's not increasing at the big rate we saw, late last year, which is kind of interesting. But interesting dynamics. It all depends on where you're looking at. Lance, maybe you can talk about Resi Club. I've been a user of Resi Club probably since almost day one, probably the 1 month after you started when I reached out to you. And again, I spent a lot of time on my YouTube channel talking about housing market trends we're seeing right now, national level and also states as well. And I think you do a fantastic job. Like honestly, like the best website in my personal opinion, based on trends, articles about what's happening. My personal favorite is inventory now compared to 2019 by the city and also by the state as well, because that can really help us figure out which direction those markets are headed. So maybe you can kind of touch really briefly regarding that, what you're doing there at Resi Club.
Yeah, and before I jump to that, do you go through some of the interactives and take a look at your market for some of those that we create?
I only look at the articles. So the
Okay.
articles you post, yeah. Is there something
Okay.
beyond that I should
Sometimes
be aware of?
yeah, above all the maps and charts, or at least the ones, at least the maps, I have a note there above it that says click here to view the interactive of it. I'd
Hmm.
love to get some of your feedback sometimes on that interactive data, right? For like the Sacramento area and your thoughts if any of that stuff is useful. But so
Cool.
over at Resi Club, we're a news and research outlet that tracks the US housing market. We track home builders, we track regional variations across the country, county, metro, zip code. We look at inventory, we look at prices, and then we're also looking out. We're looking at long-term trends that are occurring in the housing market, whether it's population, whether it's births, immigration, the shifts in the sizes of households, all of those different factors to try to figure out not just where the housing market is at any given moment and how that varies across the country, but where it's kind of shifting towards and what are like these bigger secular shifts happening in the housing market. And we also get good commentary from different sources. I have an annual call that I do with like KB Home CEO to get his thoughts on the housing market, what they're seeing, and different executives. But our big niche is a lot of visuals, a lot of maps, a lot of charts, and we try to really boil down the point really fast. And I think everything that I just said in the past, like, I don't know, how long have I been on here? Like 30 minutes? I could probably make a few maps and charts to where you could just look at it in just a couple of minutes and have really got a lot of the gist that I delivered over this time. And so I think that's what our niche is, just really boiling down these points, making them concise, making it just make sense to people. People can sign up for my free newsletter at ResiClub analytics.com. If you just go into Google, type in Resi Club, you'll get directed to my site. You just type in your email and you get put into my free list. And then I also have a premium subscription where I do 3 additional reports, a lot more regional data, and then my webinar that I do monthly.
Amazing. Yeah, I've been on your newsletter for quite some time now and enjoyed reading those articles, and the visuals and graphics that you share is just top notch. It just really makes it really easy to see, okay, here's the US, here's the areas in which prices are up by whatever it is. You really can see the visualization of housing market trends, which is really like there's no other website that I'm aware of that really does it quite like yours, which you do, again, amazing job at it. So really appreciate
Well,
it.
I appreciate that, Jason. And yeah, housing, always digging into it. And I feel like the thing that I'm trying to figure out is just at any given time, having my head to the payment and just trying to figure out where the housing market is shifting, trying to make things make sense for people. And so if they want to sign up, just go to resiclubanalytics.com.
Awesome. Well, amazing. Well, thank you everyone for watching. And Lance, thanks for being a guest on the Tristan Stowe show. I'm just a fill-in today, but it's nice to meet you in person. I know we've been chatting over the past couple of years, but appreciate your time, and everyone who watching this webinar. Really appreciate your guys' time as well. And hope you guys all have an amazing day.